Good morning, everyone. Thank you for joining us on this session where we're hearing from Invesco, or Robin West, who manages Invesco Perpetual UK Smaller Companies Investment Trust. Robin's been a long-term member of the team at Invesco, in charge of IPU. It's got more of a balanced approach than most peers, with a barbell portfolio currently employed, giving exposure to both defensive and more cyclically exposed companies, and showing their conviction on the current opportunity. The trust was at 30th of June geared to the tune of 6%, and this is the first time that the managers have been geared. Well, they have been geared for about the last 6 to 9 months, but that's the first time for a long time that they have been geared. So looking back, it looks like good timing. Anyway, without further ado, I will hand over to Robin. Not before I just ask anyone who's got any questions. I'll address them to Robin at the end. If you can put them into the Q&A box at the bottom right-hand side of your screen, I can then arrange them all and ask Robin on your behalf. Thank you so much, and over to Robin.
Thanks, Billy, and thank you everyone for your interest this morning. As Billy says, I'm one of the co-managers of the Invesco Perpetual UK Smaller Companies Investment Trust, along with Jonathan Brown. And Jonathan and I have been working together for over 10 years now, and I've been investing and analysing UK small companies for coming up to 30 years. There are three key questions looking to answer through the presentation this morning. The first is why small companies, and remind you that they are an attractive asset class. Secondly is why we believe this trust is a particularly good vehicle to get that access to UK small companies. And the third question, more critically, is why now we think is a particularly interesting time to be revisiting the sector. Looking at why UK small companies, and we use the Deutsche Numis Small Companies Ex-Investment Companies Index as our benchmark. This is the bottom 10% of the UK market, and there's a history going back to 1955. Over that time, that index has delivered a compound annual return of 14.1%, so strong in absolute terms, and some 3% ahead of the FTSE All-Share over that period. Now, why is that? I mean, there's a number of reasons we think behind this outperformance. Firstly, small companies tend to be much less well researched than large companies. So typically you'll have 2, 3, 4 analysts looking at a small company, as opposed to a large company might have 30, 40, 50 analysts analysing the business. So you can genuinely reveal hidden gems. Secondly, we're fishing in a large universe. We've got a screening system, and we screen down to around 700 or 800 companies of the size that we could invest in. So you can find a great business that can dominate a niche. And one of the attractions of finding a company dominating a niche is because it's a niche, it tends to attract less competition. So the margins and the returns that you can get from that business are less likely to be competed away. And it's easier for a small company to grow than a large company. The law of large numbers means once you get to a certain scale, compounding that growth becomes more difficult. As a small company, it's easier to deliver growth. Large companies tend to be more mature businesses. So why the Invesco Perpetual UK Small Companies Investment Trust? Firstly, against a strong performing index, we have delivered outperformance over the longer term. So 103% return over the last 10 years compared to 51% for the Numis Small Companies Index plus AIM Ex-Investment Companies, our benchmark, and 78% for the FTSE All-Share. So we've delivered outperformance. Secondly, the trust since 2015 has implemented an enhanced dividend policy, which means that we deliver a 4% dividend yield based on the year-end share price. So that's the 31st of January share price. And also, we're trading at an uncharacteristically wide discount of around 16% at the moment. So you're paying 84p for a pound of assets. Finally, why now? Well, the UK has really been an orphan asset class since the Brexit referendum, and the shenanigans we've had with myriad of chancellors and prime ministers since then has meant that UK and overseas investors have avoided allocating any more assets to the UK, and indeed the UK has been if you look at the Bank of America Merrill Lynch Fund Manager Survey, we've been one of the largest underweights in that survey. Interestingly, that seems to be changing. We've clearly got a majority government in the Labour government in the UK now, who are painting themselves as very much a centrist party and with a growth agenda. And we haven't been able to say this for some time, but the UK looks a beacon of relative stability in the global stage. With you look at the French elections with strong performances by the far left and the far right, and obviously got the uncertainty of a US election coming up. That's led to, in July, we saw a narrowing of that underweight relative to or in the UK. Secondly, UK valuations look very attractive relative to both their own history and to global markets. And this valuation or undervaluation of the UK, we've seen a marked pickup in takeover activity. The valuation is being noticed. So we've seen private equity approaches for businesses. We've seen corporate approaches for businesses. Much of this is, or the majority of these have been overseas buyers. And what we've also seen increasing premium being paid for those on takeovers. We've got the prospect of interest rates cuts both in the UK and the US in the second half of the year, which again will demonstrate the relative attraction of equities compared to cash. And the UK government has recognised the importance of the UK equity market to the UK economy. We've seen under Jeremy Hunt the proposed introduction of the UK ISA. We're hopeful that Labour will go through with that, and our understanding is that they are supportive. They've also got a pensions review going underway, which we would expect to encourage more investment in the domestic market as a result of that. And we've had the Mansion House Compact, which defined contribution schemes have signed up to, which will allocate up to 5% in UK unlisted, but also AIM listed stocks. And we're again lobbying for that to be expanded to cover all UK small and mid cap companies. Interestingly, this renewed interest in UK small companies is not just a UK phenomenon. And our dealers this morning were highlighting that when we look at the US market, we've seen a period, a very short-term period, of outperformance of small versus large. So if looking over the 5-day outperformance of small versus large in the US, it's the greatest since 1987. Looking at that long-term outperformance record of smaller companies, and this is the data I was referring to previously with that 14% compound annual return. To put that in pound terms, if you'd invested £1,000 in the FTSE All-Share back in 1955, you'd be sitting on £1.4 million today. If you'd have put that same £1,000 in the Numis Small Companies Index, you'd be sitting on £9.2 million. So just showing the power of compounding. What we want to show on this next slide is that it's not just been a short period of outperformance. This has been a long-term phenomenon. This is looking at rolling 5-year performance, comparing small companies to large. And what you can see, where you're above the line, small companies are outperforming. Where that blue bar is below the line, small companies are underperforming. So by and large, over the last period since 1955, you've been better off investing in small companies than large within the UK. The exception to that was the 1990s, and that was a period where small companies were giving you a positive absolute performance, but large companies were performed more strongly. And if you drill down to what sectors were performing strongly, it was sectors that had a greater representation within large cap indices. So oil stocks performed well. You had pharmaceuticals performing well. So Glaxo was very highly rated as a growth stock. You had the demutualizations of a lot of the Abbey National, Halifax, and the other building societies. And you also had telco stocks outperforming on the back of the internet, the booming in the internet, and the increased penetration of mobile phones. So we feel there were specific reasons why large outperformed small over that period. So why now? Well, looking at the valuation of small companies, this is the forward price earnings ratio for the Deutsche Numis Small Companies Index ex investment companies going back over the last over the period to 2004. And what you can see is that we're trading at a discount to our long run average, and generally the sector has troughed around 8 times and peaked on 16 to 18 times, and we're trading on about 12 times currently, so below our long run average, and further scope for those PE ratios to expand. Put in a global context, and this is looking at the 10-year forward PE ranges for a number of global markets. The blue bar shows the range between the 20th and 80th percentile that the markets have tended to trade at over that time, and the pink dot shows where we're trading currently. And you can see the US has always been one of the most highly rated markets and looks expensive relative to its long-term history. You then go through the Japanese, the European markets, the emerging markets, and then the UK, and we've got various indices here, both small companies, the market overall looks one of the cheapest developed markets, with only China and Italy cheaper in absolute terms than where we're trading. A slightly complicated chart. This is again looking at the FTSE small cap, the trading earnings ratio, and the dark blue line shows the price earnings ratio over the last 12 months, and that's on an inverted scale. So the higher the dark blue line going, the cheaper the market is. And the light blue line is saying, well, what performance did you then see over the next 12 months? And on average, where small companies traded on a similar valuation to where they did today, you've delivered a 22% return over the next year and a 42% over the next 2 years. And that's been our experience when we look at other downturns. Small companies tend to bounce back strongly, and that there's a persistency to that. You see an outperformance, and then you see more money flowing into the sector to drive that continued outperformance. So why the Invesco Perpetual UK Small Companies Investment Trust? Well, firstly, we have an attractive dividend. We going into a bit more details of the enhanced dividend policy. We pay a quarterly dividend. We pay 100% of the underlying income on the portfolio. Historically, that's been just over 2%. Currently, with low valuations, that's about 3%. And then we enhance that by a small payment out of the capital return to deliver you that 4% yield at the year-end share price. And you can see that's been consistently applied. We had in 2020, with the pandemic, we paid a flat dividend, and that was the only time that the dividend yield fell below 4%. But other than that, and as you say, it's been a consistent 4% dividend yield. This shows the discount that the trust is trading out relative to asset value, and you can see the dramatic impact that the introduction of the enhanced dividend policy had. with the trust trading on around a 5% discount over the period, most of the period from 15 to 19, and indeed at the end of 19 we were trading at a small premium to asset value. So at a 16% discount today, we'd see with a greater confidence in UK small companies that discount can narrow, enhancing the returns for investment in the trust. These are the figures on the long run performance. So the light blue line shows the net asset performance, so delivering a 99% return over the last 10 years. The dark blue line shows the share price performance, slightly better than the asset performance, with 103% return. And the pink line is our benchmark, which was a 55% return over that period. And again, these charts dice it into individual calendar years and 1, 3, and 5 years performance. So how is the portfolio structured? Well, we run with a number of themes across the portfolio, drilling into these in a bit more detail. The first theme is what we call roll out and roll up. Roll out is where you've got a successful business model that you're looking to roll out either domestically or internationally. And a good example here would be loungers. And they're an operator of cafe, bar operations. They operate nationwide. It's a business that since its IPO has delivered sector-leading like-for-like performance. They have a significant scope for expansion. They think they can over double the estate of sites, and the returns that they generate from their sites, because they've got that all-day trading. You get people coming in there for breakfast, and then they'll have a coffee, and then they'll stay for lunch, and in the lounge morphs into a cocktail bar and a restaurant in the evening. They're really sweating that asset. So a great rollout story. Roll up is where you're consolidating a fragmented market. And a good example here is JTC, which is the Jersey Trust Company. They're a business that offers administration services to the private equity industry, to real estate companies, and to high net worth individuals. It's a business that delivers very strong margins, very strong returns. It's a capital light business, and it's grown both strong organically and been consolidating the sector. So they bought different businesses that give them different service lines in different geographies. It's a sector that the private equity industry absolutely love, and we used to hold a business called Sarn that was taken out by private equity. And if you look at the multiples that private equity are paying, it's significantly ahead of where JTC is trading today. The second theme is what we call structural growth businesses, and a lot of these will be technology businesses, so businesses that will grow well ahead of the general economy. And a good example here would be Keyword Studios, which is one of our large portfolio positions. It's had a takeover approach from private equity, a recommended offer at a 69% premium to the undisturbed share price. The business is a great growth business. It is the world leader in provision of services to the computer games industry. So outsourced provision of services like artwork, like localization. So they'll translate the text and the audio into different languages, and they can develop a whole game for owners of different franchises. It's a business that's grown strongly organically. The sector itself has grown at about 7 or 8%. The outsourced element of that has grown in excess of that, and they've enhanced the organic growth through buying boutiques in different geographies. So they've got operations in China and India and Canada, where they can offer high quality services at a significant discount to the West Coast cost base. The next theme, and our largest part of the portfolio, is what we call cash compounders, and these are stocks that have all the characteristics that we're looking for. So they've got strong margins, they've got strong returns. Those profits are translating into cash, and they're paying growing dividends. And a great example here is Alpha Financial Markets Consulting, which is a provider of consulting services to the asset management industry and the insurance industry. So they will help with strategic consulting, they'll help with acquisitions and delivering efficiency from the business. They will help businesses implement new IT systems, delivering efficiency for the business. And again, it's another of our holdings that has been subject to a recommended takeover offer. In this case, at a 59% premium to the undisturbed share price. Finally, we have what we call self-help and recovery stocks. So these are fundamentally good quality businesses, but they've lost their way. And critically, there's a catalyst for change. More often than not, that's a change in management. And a great example here would be Avon Protection, which is a defence business. It's one of the world leaders in production of gas masks for the military and for the first responders, for police and firemen. And they also provide helmets as well, where they've got a strong market position. The business had grown well, but had made a number of acquisitions, and one of the acquisitions was particularly problematical, which led to a change in management. The new management we knew well. The new CEO has come from Ultra Electronics, where he was the CFO there, where he and the management team have done a great job of turning that business around and driving growth in the business, and ultimately selling that business onto private equity. Joss has done a great job since he's been on board. He's dealt with the problematical contracts and exited those areas, and he's driving huge amounts of efficiency through the business through just some basic strong operational delivery. So there were examples that he gave when we last met of areas where they've taken the production time down from 20 hours to under 2 hours, just through debottlenecking the business. And there's further to go. And sadly, with the geopolitical situation we're in at the moment, we think the defence area is going to be a good area for growth. So we've got a strong position in Avon Protection, and we also hold Chemring in the portfolio, which again we think is very well positioned. So in summary, hopefully what I've demonstrated or reminded you of is that small companies is a very attractive asset class, delivered strong historic returns. Small companies are cheap relative to history, and that's being recognised by the increase in M&A activity from private equity and from corporates, both within the UK and overseas. This trust, we believe, is well positioned, as Billy was saying. We've got a barbell positioning for the portfolio with some great, good, solid growth businesses, and some great businesses that are more exposed to the economic recovery coming through. You're being paid an attractive yield for holding the stock, and the trust is trading at a significant discount to asset value. So you're buying those assets at an attractive level. With that, I'll close and pass over to Billy for questions.
Thanks so much, Robin. Robin. First question up. Well, just a quick highlight to those who are listening. The bottom right-hand corner, there's a box with a question mark on a square. If you click that, then the Q&A thing will open and you can ask questions there. We've got a couple of questions so far, but please do add some questions if you would like. Just touching on that discount, the discount has sort of widened over this year. It was actually quite narrow at the beginning of the year, and perplexingly, despite markets having done quite well, the discount seems to widen. But one question is, which is potentially for the board rather than yourself, Robin, but any colour you can provide would be great. Given the discount, would you consider changing the dividend policy and doing something different, like a buyback, with that sort of excess capital?
I mean, I think I'd firstly say that we do believe the enhanced dividend policy has been successful. It's delivered or meant that our discount was much narrower than the broad sector for most of that period since introduction in 15 through till 2019. And what it appealed to particular cohorts of investors. So it appealed to the retail investor, it appealed to institutional investors who had income requirements, be that charities or investors with a yield requirement. So we think it's the right policy, and the board are very committed to that. We have seen discounts broaden across the whole sector. We're somewhat wider than the some of our peers at the moment, but we would expect that to narrow over time. And I think the board highlighted that they were looking at a return of capital, again recognising that a 4% yield is attractive, but perhaps less attractive when you've got interest rates up at 5.25% yield, and there's work underway, and more will be announced in the near future on the mechanism for that return. So again, that could be a catalyst for that discount to narrow.
Great, thank you. A sort of related question is do you find the income commitment a hindrance? I can think of a good answer to that, but I'll let you answer that first.
Well, the board were very keen to not change the fundamental investment approach and investment philosophy when they introduced the enhanced dividend policy, which is why we're paying out of capital rather than searching for high yielding stocks. Our style is looking for good growth businesses, quality businesses that are attractively valued, the sort of business that can double on a 5-year basis. We like businesses that have strong cash flows and are paying some of that in dividends, but we're looking for an overall total return from the stock. So we're not chasing high yielding stocks. High yielding stocks tend to be high yielding for a reason, and that's because they've got structural challenges and they're not showing the growth. So we're using the structure of the trust and the reserves that we've built up over many years to be able to pay that enhanced dividend.
Thanks, Robin. And dividend proving an interesting topic for the questions. So getting into the weeds here, is the yield based on NAV or share price, and how much is covered by income and how much is topped up from capital?
The yield is based on the share price at the end of the financial year, which is the 31st of January. So we pay 3 equal dividends on a quarterly basis, and then the final dividend is calculated to deliver that 4% yield based on the year-end share price. Historically, it tended to be the running yield on the trust was 2.3%. Because small companies are trading more cheaply, it's currently around 3%. So it's 3/4 paid by the underlying investments in the portfolio.
Fantastic. A quick one. I mean, I've known you and Jonathan for a long time, and for a long time you've been waiting to, all through many cycles, you've always been waiting to apply gearing, and I was very encouraged as a shareholder myself that you started to get geared at, I think it was back end of last year. So maybe you could just talk a bit more about gearing, how it's structured, the cost, and how it's changed recently, and the direction of travel as far as you can see.
Yeah, I mean, the background to the introduction of the gearing, we've felt for some time that small companies were cheap, but we were looking for a catalyst for that to start to be recognised. And I think there were 2 or 3 things. One was because we started introducing gearing in the autumn, it was clear that we'd seen a peaking of inflation, and we saw that was heading southwards. We therefore felt that interest rates had peaked, and that was going to be an important catalyst for people to look back at the sector. And we just had started to see the startings of M&A activity coming in the autumn. It's accelerated, and when we look this year, it's almost been one or two over one or two a week since the start of the year within the UK small cap sector. So that was the background to the gearing. Say at the end of June it was 6%. We would expect to move that up further because we are feeling more confident on the outlook for small companies. It was pleasing to see that small companies outperformed the main market over the last quarter, and that phenomenon's both been in the UK and in the US market. So it does feel that things are turning. In terms of the cost of the debt, it's based on SONIA with a margin, which I think is 75 basis points.
Thanks, Robin. Going back to the sort of portfolio, do you set price targets for each holding? And if so, can you provide some examples how they're derived, an indication of the inherent value within the portfolio?
I mean, we don't set absolute price targets because the market's always moving. We use a number of different valuation methodologies to appraise a stock. So it'll be everything from price earnings ratios, the enterprise value, so the market cap plus the debt compared to the EBITDA of the earnings before interest, tax, depreciation, and amortization. We'll look at trade multiples. So I've mentioned JCC there. We're very aware of the values that private equity are paying for businesses. And we use a system called Quest, which provides you effectively a cash flow return on cash invested, a discounted cash flow. So there's a number of different measures that we'd use to appraise companies, but we don't have set price targets. It's a bit of a moving feast. So we'll see where as discount rates change, your price targets will constantly change, and it's a relative attraction of stocks versus other assets.
Well, I guess some of the sort of acquirers of these companies have target prices, and so are you expecting, or have you seen more M&A in the sort of growth end or the value end of the market of the companies that you own and have seen been taken out?
What's been interesting is that there has been a spread of businesses that have been taken out. So if we look at our portfolio, we've had Keyword Studios, which we'd regard as a growth business. It's got good growth potential. We think the timing was somewhat opportunistic because there's been if you're aware, there's been a lot of hype about artificial intelligence, and in that case, that had damaged the share price of Keywords. We'd spoken to the management. We were very confident on the business and actually regarded AI as an opportunity for them to drive efficiency through automation of their services, and they've got some great AI they're already using within the business. So we'd been topping up as the market had sold these things off as part of a basket of buy the AI winners, so your Nvidias and the likes, and sell anything that you think might be damaged. Clearly, EQT, who have come in and made an approach for Keywords, have also done detailed due diligence, and they're confident that the growth prospects of the business are there. So Keywords is a growth business that PE recognise the value of. We've had an approach for Crest Nicholson, the house builder, which we've had a couple of approaches. That would be more on the value side of things. Alpha Financial Market Consulting, another of our holdings, has got good growth prospects. It's more of a growth business. Again, a different sector, sitting within the sports services sector. Historically, we've seen Ergomed, a pharmaceutical services business, growth business. It's been across both growth and value. We've seen a number of takeouts of real estate businesses, which be more on the value side of things. So I think it's both growth and value. It's both PE buyers and corporates buyers. It's both UK and overseas. But importantly, the premium that are being paid is going up. And we do feel that with the amount of dry powder that private equity have got, there was a figure I was quoted of over 4 trillion of cash to invest. They can see that small companies are starting to perform, and there'll be an increasing fear of missing out. If they don't get their cash into the market, if they don't start getting the returns, share prices will move, which means that they won't hit the targets that they've got, both for investment and prospective returns. So we would expect to see continued takeover activity.
Great, that's encouraging. One question, the questions keep coming in as fast as you can answer them, so it's great. But one question about the sort of the range of market cap sizes you've got in the portfolio. How much is in AIM, how much in the FTSE 250, and I guess by association, how much in the FTSE small cap?
Yeah, I mean, we tend to look at it on more on a market cap basis. So we don't own much under about 100 million. We've at the top end, the cutoff is around 1.6, 1.7 billion, but we generally have got somewhere between 5 and 10% of the portfolio north of that. Our AIM exposure tends to run between 25 and 30% of the portfolio. We're relatively agnostic between AIM and main market. AIM can be a great market for fast-growing businesses that need to come to the market. It's cheaper and easier to raise capital for acquisitions on the AIM market. The mix between mid and small cap, I have to check. I think it's probably running. Actually, I can add. There's probably about 60% mid cap in the portfolio. So yeah, a bias to about just low 50s in the FTSE small cap. Sorry, in the FTSE 250, just under 20% in the FTSE small cap.
And do you have to sell if it gets into the large cap FTSE 100?
No, I don't think we've ever held a stock when it's made it to the FTSE 100. We certainly like to run our winners. So as long as it remains good value, we will hold it. But once it gets up to 3-4 billion market cap, we'll tend to move it on at that stage. Valuations tend to get there's a discovery effect as small moves on to large. So you'll see a re-rating. So relatively less good value. So we'll recycle that into smaller, faster growing, more lowly rated companies, and we tend to be overweight and in that sub 500 million market cap end of the market. So true small and mid cap.
And a macro question about the sort of, have you got any concerns about the new government's attitude to IHT business relief and the potential impact on AIM shares if that changed?
I mean, I think it's something that there is clearly discussion on that. I sit on a group that's lobbying for small companies. We were one of the parties that lobbied and wrote an article talking about the issues that small companies have had in terms of the number of companies that are being taken out, the lack of IPO activity, the lack of new cash coming into the sector. And so we were pleased that the government listened, or the Tory government listened. That was also that group liaises with the Labour Party and the Labour government now. I think there is a recognition. I mean, Labour are very much wanting to drive growth to be able to meet their requirements to fund the NHS and education and defence and the other areas that they're prioritising, and they're looking for economic growth to be that key driver. So I think that they will look carefully at removing things like that IHT relief. It may be tweaked. We'd actually encourage them to look at broadening the eligibility requirement to all UK small and mid-cap companies to provide patient capital for those companies, and enabling fund structures rather than just being in discretionary portfolios. So the things that they can do, we'll wait and see. I mean, what I would say is that we look at the valuation of each stock on an absolute basis, and we're confident that our AIM stocks are attractively valued and our full listed stocks are attractively valued. And to give one example, I mean, there was one stock that we hold within the portfolio that's AIM listed, and partly it has a number of founder shareholders and family shareholders who appreciate that IHT cover. If that were removed, they would look at moving to the full list. And if you look at the proportion of their portfolio held by our IHT funds, that would broadly be matched by index buying if it came to the full list. So, you know, there might be a bit of a technical position, but this thing we would expect, if that were the case, then a number of these businesses would look to migrate from AIM to the full list.
Great, Robin, thank you. I think that's about pretty much up to time now. So I'd like to thank you, Robin, on behalf of everyone, for very interesting, and also for answering all those questions. Thank you also to everyone who's dialed in. We've definitely been knocked over in the rush for enthusiasm for small caps at the moment, which I think is maybe symptomatic of the fact that there's a good opportunity out there. Thank you for the questions. We have got another couple of other presentations, one tomorrow, Aberdeen Asia Focus, and Friday, Brand Advisory US Smallers. So two very different smaller company exposures to tune into if you'd like. But thank you all, and thank you once again, Robin.
Thanks, Billy. Thanks everyone for the interest.
Okay. Cheers. Goodbye.